righty, Taylor.
It's a time.
Yeah, come on up. So, yeah. Normally, if my wife is here, she'd step in and then interview the other one and take over. But with her being ill, then it's me and Taylor.
Double duty, Brian.
Yeah. How long have we known each other? So
I've been in BNI 5 years, and that's where
Yeah.
I first met you. So,
Taylor Jones is with S&S Insurance. So he does a whole lot of commercial insurance. So for those that are out there that are buying commercial properties, this is your guy right here as far as doing commercial insurance. So let's talk some commercial insurance. I know it's an exciting topic.
my favorite, sexiest topic,
and-
Brian.
Yeah, and did you notice everybody moved the front of their seats because they were getting ready for this?
Edge up.
Yeah, this opportunity. But I'd like to let everybody kind of share a little bit about their background and how you got into insurance and what you love about insurance and what you love about multifamily insurance, even better.
Yeah, these are all great topics. So, like Brian said, Taylor Jones. I actually grew up here in Brentwood. My mom's house is just down the road in River Oaks.
Unicorn.
Yeah.
Unicorn.
Yeah.
Him and Lisa.
Born at St. Thomas Midtown. Back then it was Baptist Hospital. And I found my way to insurance. I actually worked in the funeral industry. Believe it or not. Yeah. So I used to in the state of Tennessee, you are either mortuary licensed and your customers don't have a pulse. Or you are insurance licensed and your customers do still have a pulse.
Yeah.
So I dealt with pulsing customers, if you will. And I sold cemetery product called pre-need funeral. Essentially, you can purchase your funeral before you die and fight inflation by doing that. Yep. A lot of people, it's a good fit. Like, example, let's say that you're not able to purchase life insurance, heart attack, terminal diagnosis, something like that. You can still purchase your final services before you need them. And yes, so I got life and health license. Spent some time doing that. Decided to move on from that industry, dying industry.
Yeah.
Not a lot of people.
Yeah.
Not a lot of people were choosing traditional barriers.
He'll be here all week.
Yeah. Become a client and call me anytime.
Yeah.
So a lot of people were moving away from traditional burial. A lot of the that service was kind of, going a different direction. I decided to make a change to something a little more lighthearted. So now I get phone calls from people whose buildings have burned down and have been in car accidents. So, property and casualty insurance.
Yeah. I know you do a lot of multifamily insurance,
Yep.
right? So kind of talk about how you kind of got into that little bit of a niche.
Yeah. So I spent my first year in the business doing what a lot of agents do. I wrote home and auto insurance, renters insurance, RVs, boats, kind of learn the ins and outs. I had the opportunity to go to commercial producer school, which is basically like college for insurance agents, where you learn about commercial insurance, commercial policy forms, the indemnity language that works with that, how casualty works. In a property and casualty package, we have the property bucket and then the liability bucket, which is the casualty. And I am a real big fan of complexity, and commercial insurance is still a world where as a purchaser, as a property owner, as a business owner, you have some opportunity for manual underwriting. Most of our personal lines insurance has moved to algorithmic pricing. We've all seen advertisements from major carriers where it's like, get online, get a quote in minutes, right? As risk profile grows, moving pieces kind of grow. There's more that goes into it. So most of the time, carriers are still underwriting those risks with a human being. some computer assistance, but at the same time, you really have an opportunity to kind of tell a story.
Yeah.
And help people. I always say I like to fix insurance problems. So
There you go.
yeah.
Yeah, so, and again, ask any questions as we're going through here, right?
Yeah.
From that standpoint, so, yeah, I know, when you're talking about risk, right? And with multifamily, there's a lot of things, and then dealing with, Fannie and Freddie requirements, right?
Yeah.
I mean, talk about some of that.
Yeah, I was hoping we would get to touch on that. So obviously, thanks for letting Trey go first. Great hair. He's handing out millions of dollars. I mean, and then I get to get up here and talk about what's going on in the insurance market. So fantastic setup there.
Yeah.
Okay, so big picture. I don't know if you guys ever check your news feed or whatever. Had a couple storms here in the United States this last little bit. So insurance is cyclical. We are in what is known as a hardening market cycle. So there's a couple layers that I think everybody should be aware of, just to kind of educate yourself on the general insurance industry. Okay. So bottom level is us as clients or customers of the carriers. Then you have carrier level, and then above that is reinsurers, right? So reinsurers are people that sell insurance to insurance companies. A lot of the headwinds that we're going to face probably over the next couple of years are being driven by primarily catastrophic losses and reinsurance agreements. Okay. So when an insurance carrier wants to write business in a state, they coordinate with the state's Department of Commerce and Insurance to file policy forms and rates. Those filed forms, you got like base form and then endorsements that go on top of it. There's not a lot of ability without refiling to change the insurance contract. So from an internal standpoint, carriers help turn off and on the spigot through something that we call guidelines, right? Broader market capacity is shrinking. So insurance carriers are required to carry a certain amount of capital to pay claims on reserves to operate. They can sell up to a certain percentage of that as premium, as policies that are out there, right? So that kind of represents their exposure book. And when we say we have like a reduction in capacity, it means that carriers have less of that bucket to kind of use for multifamily owners in the business. They're talking to a lender like Trey or like conventional. Their bank might say our multifamily bucket is full, right? We have less capacity for loans. So in the insurance industry, with this hardening cycle that we're probably going to be moving into for a little while here, we're seeing less capacity. Less capacity equals less competition, higher rates, a lot of rating pressure, and that means for current policyholders and people that are seeking new coverage, we're going to see some effects there. Yeah. So to answer your question about Fannie and Freddie, okay, so it's awesome that these products are available from an insurance standpoint. If you are looking at a non-recourse loan, your insurance options are pretty limited because like Trey was talking about, right? Like we're using the actual property and asset to collateralize that. The insurance piece of it is designed to indemnify the person with the most financial interest against loss, right? If the property is underwriting the loan, the lender can tell you, you gotta have X, Y, and Z. They can change those requirements at any time. And then coupled with some of the economic factors that are going on, it can get pretty challenging. So with private lending, because you're on it too, right? The bank isn't just looking at the property. You do have some additional options, right? And when I'm talking to a multifamily client, one of the things that I try to determine is the level of their sophistication as well as the portfolio sophistication, entity structure, partnership structure, and I try to really get an idea of what does the total like risk profile look like, and then we try to create some solutions around that. So I give you kind of like two rough examples, right? So entry into the market, somebody's formed a partnership, they've called Trey, first bite on multifamily. We are probably going to insure conservatively. And when I use the term conservatively, I mean full insured value, replacement cost, all requirements met for the loan. We're really looking less at bottom dollar pricing and more about like protection, right? Making sure if something happens to this property, which is underwriting the loan, what kind of major problems are we going to have if it's not fully protected, right? And like Trey was talking about, like the bad boy clause, right?
Yep.
Yeah. So we want to make sure if something goes down, we have some recourse, right? The other example that I'm going to use is you are heavily self-funded, very low leverage, lots of equity across property portfolio. The property portfolio maybe has multiple locations in different geographic areas. So you're essentially as an owner, you're creating your own like miniature insurance company, right? So you have lots of risk kind of all over the place. It's spread out. You tell me, hey, our plan is to continue to hold these properties long term. If something happens to one, we're not super broken up about it. We've got lots of operating capital. I'm going to look at insuring that very aggressively. And when I say aggressive insurance, I mean, we are cutting corners where we can. We're insuring low. We're going very high deductible. The thought process here is cash flow and premium is what matters the most, right? So we're trying to lower the cost of insurance to keep premium or keep profits as high as possible. And if something happens, we're willing to self-insure a little bit more of that risk because we have more of our own equity and stuff in the property, right? And obviously we evaluate that on a piece by piece basis. So you got another question? I'm like Trey, I can keep going, man. Like,
Yeah.
how many hours we
Yeah.
got?
Nick, go ahead.
How does loss run affect, how does the type of claim affect loss run, affect premium, in the sense of act of God versus maybe something that's not an act of God?
Yeah, really good question. Okay, so I'm going to take a small step back from that. Going forward, what we're going to see is dependent on risk. We're kind of looking, carriers are looking at two things: catastrophe exposure and then basically non-catastrophe exposure. So let me give an example. A multifamily building in the state of Tennessee, which is a wind and hail state, has a lot of catastrophe exposure. Okay. We're going to see, whereas the another like commercial example, we're going to have to go outside of property here. But like if I got a drywall business, I'm a one-man shop, I got a van, I have very low catastrophe exposure. I've got higher liability exposure, right? Because my product's completed product is my casualty is really what the big piece of that is. So when it comes to catastrophe exposure, if anybody has been monitoring what's going on in Florida, Louisiana, coastal exposure states, the insurance markets there are falling apart. It is not 100% the consumer and policymakers' fault here. It's also not just hurricane fault, but the reality of Middle Tennessee and the Southeast is we are we essentially have higher catastrophe exposure. So we're going to see more premium allocate during these increases in catastrophe exposure type risk. We're, 15 to 50% is kind of like the projection. That doesn't necessarily mean here in Tennessee geographically. There's obviously some things that we can do. So, okay, to come back to losses, right? One of the things that I highly recommend because of the reduction in capacity is if you're approaching as a purchaser for a new property, one of the things you request from the listing agent is loss runs. Very similar to like if you're getting Fannie or Freddie to come out and Brian and Jan are out picking up trash. So like it looks good, right? We also want it to look good for an insurance inspector and for you to know what you're getting on, right?
Yeah.
You got a story on it?
Oh, no, I just Trey telling that story.
Yeah.
So,
Yeah.
Just,
Yeah.
because I mean, yeah,
So
we gathered the forces, Joanna, who's my personal assistant, she actually went with us that day to go
trash
do
up.
that,
Yeah.
yeah. So did Canal and Carson back there, and it was on all.
all hands on deck. Yeah.
There,
Make it-
because not only was that big investor coming, but so was agency, and we know how picky they are about every little thing. So we had that place looking spotless by the time they got there. But
Yeah.
anyway,
Yeah.
that's, I was just thinking about that. So we did that twice, by the way, just to let you know.
Yeah. I mean, you got to get the deal done,
So,
right?
Yeah. We had to end up doing
Yeah.
that twice. But anyway, from that standpoint, that's going, and that's interesting on the run loss rate, right? Because
Yeah.
that is, as brokers, that's one of the first things that, when we know that that's going to be asked. So that's one of the first things that we are requesting, right, from that standpoint. And you just, we know, okay, when the first thing somebody's going to look at based on the financials of the property is to take a look at, okay, what do we think is going to happen with taxes, right? Meaning, is this in a county that taxes the property at the sell, or is it done every 3 or 5 years? And if that's the case, then when? But then one of the other things is okay, this is what they're going to need to go check for insurance, and that's also going to determine on their underwriting what that's going to look like. So,
Right.
Did you have another question?
Well, I think what I was trying to get after is when
Okay.
I get the loss run, I want to be able to look at it and know, like, so a hailstorm that wiped out the roofs versus like a kitchen fire, because I feel like the act of God may not impact, the premium's already impacted by the act of God because of the zip code or however. Is that true, or am I?
And I was gonna, come back to that. So for a property that we're already on, right? One of the things that we're looking at, and where your agent and insuring partner, one of the things I really pride myself on is really being a partner in the property. Shout out to Billy Joe and Next Gen. They're additional insured on a lot of our policy holders. So just a testament to how good of a job they do. But one of the things that we try to do as an agency is work with the property manager to help manage potential claims, right? So storm comes through, rips the roof off. We got to file a claim, right? If we evaluate that and it makes sense with the deductible and also with the plan, right? We're gonna say, yeah, let's go ahead, file a claim. Acts of God, so weather losses, wind, hail, lightning, that kind of thing, typically fall into two different buckets. If it is March 2020 tornado, a lot of times we will have an opportunity for a carrier to declare what we call a catastrophic loss, right? Catastrophic losses still count as losses. However, they impact policyholders and agencies different. So, just kind of behind the veil here for you guys as insurance customers. Part of